And welcome. Today we look at Chapter 4, the second set of problems, which we call fun with other ratios besides the DuPont equation ratios. We have a company called Diode Incorporated. Here are their balance sheet. They have $20,000 of cash, $40,000 of receivables, inventories of $50,000, leaving total current assets to sum to $110,000. Net fixed assets of $90,000 for total assets of $200,000. Accounts payable are $20,000, notes payable $30,000, total current liabilities therefore sum to $50,000. Long-term debt is $60,000, common equity of $90,000, summing to total liabilities and equity of $200,000. Sales are $200,000 and net income is $15,000. The current manager believes that the current ratio of the firm should be closer to the industry average of 3, assuming no changes in sales or net income. Any changes in current assets would be due to inventory buildup. The inventory buildup would be financed through long-term debt. How will return on equity change? And what will happen to the quick ratio? The present current ratio is 2.2. To get to 3 using inventories, we need to increase inventories by 40,000. Current return on equity is 15,000 divided by 90,000 for 16.7%. The proposed return on equity would be 15,000 divided by 90,000, 16.7%. The current quick ratio is 110,000 minus 50,000, which divided by 50,000, which is 1.2. The proposed quick ratio would be 150,000 minus 90,000 divided by 50,000, which would be 1.2. If the firm's cost of debt is 5% and its tax rate is 25%, what is its basic earnings power? Well, basic earnings power is earnings before interest and taxes divided by total assets. And earnings before interest and taxes is equal to earnings before taxes plus interest expense. And earnings before taxes is equal to net income plus taxes, where taxes is equal to earnings before taxes times the tax rate. Earnings before taxes, which will be net income plus earnings before taxes times the tax rate. With a little algebra, we can then say that earnings before taxes will be equal to net income divided by 1 minus the tax rate. So we take our net income of 15,000 and divide by 1 minus 0.25. Leaving us of earnings before taxes of 20,000. Interest expense will be long-term debt times the cost of debt, which is 60,000 times 5%, which is 3,000. So earnings before interest and taxes will be 20,000 plus 3,000 for 23,000. So our basic earnings power will be 23,000 divided by 200,000, or 11.5%.